Okay, well, Rajat Bhattacharya is a senior investment strategist at Standard Chartered. He's joining us now. Rajat, good morning. Good to have you with us here. Thanks very much. I mean, confusing price action, isn't it? A big fall in yields last week in the US, big jump overnight. Everyone seems to be just treading water, looking for direction. What's your sense?
Hi, Prashant. Yeah, pretty choppy markets there. I think all eyes are on the Middle East, of course, as you mentioned repeatedly in your call. And that's primarily because of the linkage. These are tragic incidents that are going on, but the linkage to the global markets is through oil. And there are two scenarios that we painted recently. And the first one is, of course, that whether the conflict remains constrained within the confines of Israel and Gaza, or whether it spreads out and involves other parties in the region. Iran is the key. Will Iran join the conflict is the key. So that's the other scenario. If Iran and other parties join, we are going to see some escalation. But I should add that in history, I mean, if you go back just 30 years, over the last 30 years, we noticed that these kind of conflicts, geopolitical conflicts from the Middle East, have not led to a lasting impact on oil prices. Yes, there are short-term escalations and oil prices rise, but the last 30 years of history show that these are not long-lasting. So that's good news. But you have to go back to the 1970s, of course, to see the lasting impact in those Arab-Israeli conflicts.
Sure. Rajat, hi, good morning. The other problem is that headline inflation was coming down for many countries, right? If it goes back up in an environment where we have higher oil prices, higher inflation, that can set inflation expectations to another level and make it harder for central banks to win this fight against rising prices, which most people believed we were at the end of. So how do you see central banks react from here on? And as an investment strategist, what would your call be now?
Yes, that's correct. So oil and inflation, that's the linkage again from oil to the markets. U.S. inflation, for instance, latest numbers, excluding shelter, was on the downtrend. So that was good news. But shelter is still up. But oil can, of course, change that trajectory. So this is why the yields are reacting, right? So bond yields are reacting partly because of those worries about inflation expectations stay high. Nevertheless, I think overall, in terms of answering the question on what to do with investment strategy here, the upside to bond yields is limited. We are seeing yields at around 4.8%. That's close to where we got earlier, the 16-year highs. They could go to 5%, probably. So the upside is limited. There is a huge downside if all this, events and the monetary tightening that we've seen leads to the growth slowdown that we were already expecting. So we are expecting a growth slowdown globally as led by the developed economies next year. And that gives further upside to bonds in that sense. So the yields will come off. You get corporate capital gains. So in terms of investment strategy, we still prefer bonds globally over equities. Now, where this conflict goes in the near term is something that we need to watch, and that again leads to our preference for bonds over equities in the very near term.
Hi, Rajat. Good morning. I recall the last time you were telling us that India contributes a far more in terms of GDP to the world GDP, though in terms of stock market capitalization, well, it's relatively lower. So that shows, the kind of headroom that India has as well from here on. But given the kind of data that's coming up from China, we just got the Chinese Q3 GDP number a few minutes ago, and that was a little bit better than what was being estimated. At current valuations, how do you toss up? If you're looking at equities, you already told us that bonds are what you prefer. But if looking at the equities and particularly emerging markets, how does India rank at current valuations with the current tensions as well?
Yeah, that's right, Nigel. So India's valuation, of course, is around, if you say forward valuations around 18 times PE versus, let's say, China less than 10. But there is that is justified. India stands out, as we've been repeating
Yes.
on this forum and elsewhere. India stands out in the emerging market world. And I'll give you some basic statistics to justify that. India's growth rate is around, is likely to be in the next 1, 2, 3, 5 years, likely to be around 6 to 7%, right? China is going to be probably closer to the 3-4% mark. Now, if you take India's real GDP growth of 7%, add to that inflation, you're getting a nominal growth of 12%. Now, historically, over the past several decades, you've seen that India's earnings growth track the GDP growth very closely, the nominal GDP growth. So earnings growth have been tracking that 7 plus 5, 12% nominal GDP growth over the last several decades. And that there's no signs of that changing. So going forward, if you're going to get an earnings growth of 12%, these valuations are not too expensive. So if you're an investor looking at 1 year or beyond, next 3, 4, 5 years, and you're going to get that 12% nominal growth, economic growth, and Indian earnings track that economic growth better than any other emerging markets, those valuations stand. So it shouldn't be out of equities. So that's not what we are saying. But so you should be very much invested in the longer term. But in the near term, I guess, the bonds look that much more attractive.
Okay, got it. At a time when, things are not looking great on the geopolitical front, right? Bonds are looking a little more attractive than equities. Thanks a lot for joining in. Appreciate your thoughts.